Hi, everyone. My name is Robert Hackett, and I'm a senior writer at Fortune, where I co-lead our FinTech coverage and our Brainstorm Finance conference. It's a pleasure to welcome you here today, and a pleasure to speak with Brian Brooks, the acting comptroller of the currency in the U.S. A longtime lawyer and later general counsel of the mortgage giant Fannie Mae, and chief legal officer of Coinbase, the biggest cryptocurrency exchange in the U.S., Brian has a pretty unique perspective on the world of regulation when it comes to fintech and crypto. The theme of our conversation today is banking on the future of money. So, Brian, to the ears of an outsider, banking law might sound like a pretty sleepy discipline, but since your appointment in May to your current role, you've been on a tear shaking things up in the Treasury Department quite a bit. You've been greenlighting more fintech startups to become national banks. You've clarified that banks can custody crypto. You're working on a national fintech charter. Why the rush? Why have you been so busy lately?
Well, Robert, first of all, thanks a lot for doing this, and thanks everybody for tuning in to this discussion. My basic view is the future is not going to wait on us, okay? And so I've got two basic motivations going on here. One is I see other countries racing ahead a little bit faster than we've been racing in the U.S. on issues like e-money, on issues like networks and faster payments and all of those kinds of things. And my role as the U.S. banking regulator is to make sure that we're competitive and abreast of events, simple as that. And I can't let the country fall behind when I see what's possible elsewhere. That's why speaking to a Singapore-based audience is such a powerful thing to do. But the second thing is, it turns out there are innovations going on that are likely to make finance safer, more accessible, more resilient, more counter-cyclical. And if those kinds of things are things that I can help incubate, I mean, that's my job, right? My job is to make sure that we have a safe and sound system and that fair access to financial services is available for everybody. So I think these are core things that a country that historically has been a finance leader needs to grapple with if we're going to move into the next phase.
One of your major areas of interest is cryptocurrency. And in fact, some members of Congress have criticized you for it, saying it might occupy too much of your time and attention. Why is cryptocurrency so important to you in particular?
Well, it's a great question, and I'll answer that. But let me just first say we've gotten equally many fan letters from senators and members of Congress as we have gotten criticism. I mean, I got a letter from the chairman of the Senate Banking Committee not too long ago, praising our work on crypto and networks and asking for more and more clarity. So I would just begin by saying there's nothing you can do in Washington that isn't without some controversy. But controversy means you've got both supporters and detractors, and I obviously have both. My personal interest in this, Robert, has a lot less to do with cryptocurrencies themselves than it does with the idea that our future is a networked future. And I think this is what we learned in the 90s with the internet. People forget there were a lot of critics of the internet in the early days. I like to tell the story as a lawyer that when I was a young lawyer and my law firm first got emailed, there was an American Bar Association directive that told lawyers they couldn't send privileged information by email because to do so would waive the attorney-client privilege by sending that information over other people's computer servers. And that seems like a ridiculous thing to say today, but it was in fact established wisdom in 1994. And I think we're seeing the same thing with crypto today, where the main thing people see in it is illicit activity and money laundering and fraud, which does exist. And it's important we not downplay that. In any early technology cycle, you always see the bad guys adopting first for whatever reason. We have to grapple with that. But the underlying promise of the networks that are powered by Bitcoin and other cryptos is the reason I'm interested in it. It's because I believe in the future, we will see the role of banking and even the concept of what banks are change fundamentally. We're going to go from having big citadels of finance that have your deposit account and your investment account and your insurance and everything else. We'll see all of that decentralized by networks that will make things cheaper and faster and more resilient. And that same way we did the internet 30 years ago.
That's quite a vision. And in fact, before we started this panel, we were discussing a little bit a kind of far out idea that you've been floating around in private corridors relating to cryptocurrency and its potential to lift people economically. Could you share us that idea that you're working on? I believe you call it Country Coin.
Yeah, so Robert, maybe I'll break a little news here, but let me just take everybody back to a time about 25 years ago when Muhammad Yunus and the Grameen Bank won the Nobel Peace Prize for a financial innovation. So I want to put you in mind of the idea that finance can be a force for real change and real good in the world. And the simple idea that won them the Nobel Prize was making small microloans to poor women in Bangladesh. Something as simple as that changed the world. So here's what I see if I look out in the world today, and here's how crypto could help solve it. What I see in the world today is there's a vast gulf in wealth between the developed world and the developing world. And one of the main differences between those two parts of the world has to do with education levels. So in the developed world, you have 95+% literacy rates, you have 12th or even 13th grade average education levels and everything else. But if you look in places like sub-Saharan Africa or South Asia or certain parts of Latin America, you have countries that have an average education level of 6th grade, and it's very hard culturally to get people educated. It turns out that if you increase the average education level in a country by even 1 year, you raise GDP in that country by almost a full percentage point. So just think about that for a moment. If people get educated 1 extra year from 6th grade to 7th grade, that country will generate GDP in the tens of billions of dollars. Here's the idea. Imagine a crypto token called Country Coin that represented a claim on the increased tax revenues associated with that increased GDP caused by higher education. And imagine if you could induce people to take online classes, which is one of the main use cases of crypto, by the way, in exchange for which, as they complete classes and pass tests, they get these tokens, which represent a claim on a trust fund created by that country's finance ministry. Here's what would happen. You would equitize that country's economy. Growth investors would see those tokens as valuable in the same way that they see stock in a growth company as valuable. They would say, oh my goodness, Colombia has raised its education level and suddenly there are these tokens worth billions of dollars. We want to buy those tokens from the people who took the education classes. That creates an amazing flywheel effect where the people who took the classes want to take more classes to get more tokens, and in doing so, raise the productivity level of the country. This is a way of increasing equity, increasing growth, without raising taxes and without pitting the rich against the poor. It's the best idea for crypto I've ever heard about. And I will just tease a little bit and say the World Bank is starting to work on an analogous project that I first discussed with them about a year ago. And I think fully decentralizing this, creating a permissionless country coin in countries that are on growth trajectories from developing to developed status is one of the biggest ideas in finance today. So country coin, you heard it here first.
That's a pretty crazy idea. So are you suggesting that a government would give people who are going to higher education, they would distribute these coins to them, and these coins basically represent a share of future GDP growth?
Exactly. Or Robert, I would say the tax revenues associated with GDP growth. So imagine you're never going to have to raise a tax rate. The existing tax rate with a higher base generates more money, and a portion of that more money goes to the people who created it. Here's the egalitarian aspect of this that I find so compelling. Today, when people go and they get educated, whether it's in high school or college or in trade school, the only people who benefit from that education are the subset of those who get good jobs. So some people go to college and they don't get the job, and so they spent the money for no reward. But it turns out that the whole country's economy does better because they went to college. That doesn't seem fair, right? They helped generate the GDP growth through higher literacy rates, higher numeracy rates, et cetera. But the only ones who get a share of that increase are the people who got the job, and they only get that through their employment. This is a way of spreading the wealth that is created by education across everybody who got educated. It creates favorable incentives. It puts us all in this together where poor people want rich people to get rich because it raises the value of the token. And the token incentivizes them to get educated and to get richer themselves. When we all get richer together, there's more social harmony, there's more growth, the future looks brighter for everybody. I'm telling you, this should be the next Nobel Prize. It's a big idea, and if we come together, we can do something as a fintech community on this.
It's definitely a big idea, and it raises some questions in my mind, like about the implementation. If I'm going to, get my sort of doctorate in an abstract highfalutin philosophy kind of degree and want to be holed up in an ivory tower somewhere, am I contributing to GDP? Do I get a share of that GDP? Or is this really supposed to be people who are pursuing AI software? And
not at all. And so Robert, here's the beauty of it is, it turns out in society, we do pay software engineers more than we pay philosophy professors. Most philosophy professors make whatever Starbucks is currently paying for baristas, right? That's my whole point about how people who get educated get paid highly differentially on the employment market. But the data shows that it's the simple fact of higher literacy and higher numeracy. It means you're going to raise your children differently. You're going to be more likely to live in different kinds of neighborhoods with people of similar educational backgrounds. And so it turns out that GDP growth is affected by the philosophy professors, no less than by the software engineers, even though employment markets make a distinction. And so the beauty of this approach is the employment markets can still treat you differentially, but everybody shares in national wealth creation. We're all in it together. That's the message.
Where, in your opinion, do you think something like this could actually take off? I mean, the U.S., people talk about it. It's a morass of regulatory confusion and overlapping jurisdictions and things like that. Where in the world might something like this be appropriate and viable?
Well, I think the first places you're going to see it, like with any new technology, you'll see it in the places that need it, right? And in the U.S., one of our problems is, for all of our issues, we're a modern society, relatively stable. Yes, we were late to 5G. Yes, we were late to fintech and crypto, but still the system works good enough that we don't need these things. But if you look at places like Afghanistan, where the percentage of girls going even to elementary school is depressingly low, or if you look to certain countries in South Asia where large percentages of people live in Rohingya refugee camps, or to parts of Latin America where indigenous communities don't have a tradition of education the way that they might in Western Europe, these are all places where creating the incentive can be very, very powerful. And they're places where finance ministers are looking for ways to improve their labor force competitiveness. This is a way.
You said that you have approached the World Bank with this idea, that maybe they have even gotten some early traction. How far along is this to becoming a reality? Like, what is a realistic timeline for deploying something like this? When could we see this happen?
Yeah, so the World Bank just finished a pilot of a project that they call Evoke. So Evoke is a crypto token created by the World Bank and piloted in Colombia. They're announcing a sort of results of a pilot here just in the next few days. So we'll learn more about the learnings of Evoke, which is not exactly country coin, but it has the same insight, which is that crypto tokens can draw people to online education platforms more than just all the social sort of cultural norms will. So we'll see what their learnings in Colombia were. But my basic view is this is the kind of thing that could be deployed almost immediately. There are already existing educational platforms powered by crypto where you go online, you take the program, you take the test, and you're given a few tokens in return from that. So there's no technological reason this couldn't happen right away. What's required, I think, is for us as a fintech community and for my peers as regulators to recognize this as a relatively lightweight, non-interventionist, non-us against them policy approach to letting everyone get richer together, which is what the developed world ought to want.
You described this as potentially permissionless, which, as I understand, has been something that has made regulators uneasy, the permissionless aspect of various different cryptocurrencies. How are people going to get on board with something that is permissionless, that potentially doesn't have, official body backing it and greenlighting, who's okay and who's not okay on the given platform?
Yeah. Well, so here's what I would say about the concern that regulators have about crypto. And I want to be super clear about this because there are real concerns. The concerns are not that blockchains are permissionless. The concern is that there's the possibility of anonymous transactions between bad guys, right? That the people are making contributions to terrorist organizations, or they're evading the tax authorities, or they're engaging in criminal money laundering or child trafficking or whatever. These are real concerns. They're deadly serious, and they're things that as governments we have to get our arms around. No more, but no less than we have to in traditional finance, because obviously a certain amount of that flows through the banking system every year too. It's just that there's a pseudonymous and anonymous factor in crypto that makes it a little bit different. So we have to solve for that. I think there are technology ways of solving for that, but at the same time, I don't want to see us throw babies out with bathwater. I do want us to absolutely be deadly serious about the law enforcement and sanctions implications of this, while at the same time recognizing that permissionless systems are highly transparent. In a system that anybody can plug into, anybody can see what's going on the blockchain. We can see every set of transactions that are released every 10 minutes on the Bitcoin blockchain. And we have software solutions in the form of various, chain analysis providers that help law enforcement to search and find the bad guys. So we must take that seriously. But at the same time, as I say, there are such massive benefits as there were on the internet, which presented its own set of law enforcement challenges early on, but where we later came to reap all the benefits. So I'm trying to envision a future world where we've gotten our arms around the problem, but maintained focus on the benefits of a networked future.
as regulators try to get their arms around the problem, as you said, there is the ever-present threat that they could, as you also said, crack down to the degree that they stifle it and smother it before it actually gets to bloom and become a vibrant industry. There have been rumors, actually, to that effect, that in the U.S. there might be a crypto crackdown coming. In fact, your former employer, Brian Armstrong, he had tweeted about this, that regulators could potentially come down on self-custodied crypto wallets. Does that rumor hold any water?
Well, I can't comment on forthcoming specific rules and regulations that are out there, but what I would say is that our priority is providing clarity about what we're comfortable with and what we're not comfortable with. And clearly there will be some things that need looking at, right? I mean, the idea of anonymity through crypto, the idea that could be used to mask contributions to terrorist organizations and the like. I don't think any of us think that's okay, and we need some kind of solution for that, and we're working on those things. At the same time, there is a significant constituency inside of this administration and elsewhere in the U.S. government that understands that what's underneath that are a lot of really important innovations that we need to harness and benefit from. I mean, if the trade-off for having country coin and having a generation of people around the world getting educated and getting richer, right? If the trade-off for that is that we're going to have to think very smartly about how to cabin these risks, that's probably worth doing. So I would just say we will come out with clarity. We will find ways of balancing these things and get to the right place, as we did with traditional finance, and frankly, as we did with Internet 1.0.
Along the lines of that potential clampdown, there are some pieces of legislation floating around policymakers have put forward that would prevent companies from holding deposits on behalf of their customers with respect to stablecoins specifically, that it would just be banks that are allowed to do this. That would obviously have a pretty big and potentially chilling effect on the crypto industry. What's your take on that proposal, that piece of legislation?
Yeah, well, so what I would say is I think the idea that only banks can hold these assets, that's a mistake. I think reinforcing the power of a single big institution in a creative marketplace is never good, no matter how good the institution is, right? I mean, anytime, there's a reason we don't like monopolies in this country. It's no matter how beneficent that particular monopolist is, there's still a monopolist who is insulated from the kinds of market incentives and competitive pressures that generally move economies forward. So I think that's a mistake. Having said that, for fiat-backed stablecoins, banks are, as Willie Sutton said, where the money is. And one of the things we've tried to do with the OCC is to provide some regulatory clarity about what banks need to do when they are holding the reserve deposits backing stablecoins. Remember, there are also other kinds of stablecoins out there. There are algorithmic stablecoins like DAI and a variety of others, compounded things that have totally different purposes. So I would say there's likely to be as much innovation in stablecoins as there are on cell phone communication apps, and people are going to pick one for one purpose and pick a different one for a different purpose. And I think markets will generate that, unless again we calcify a monopoly through legislation, which I think is never a good idea.
I've got to ask you this while we're on the subject of stablecoins. Reports are saying that Facebook's Libra could potentially come out as early as January. And I'm calling it Facebook's Libra, but I understand it's a coalition of companies and they've changed the name. It's no longer Libra, it's DM now, and they've changed various aspects of the proposal. I'm wondering if in its current iteration, whether this thing is legal, suitable, appropriate in your view, whether you think this thing would fly globally and in the US.
Yeah, I think anytime a company of the size of Facebook is going to take a significant position in a financial asset, we have to look at it very carefully. Clearly, there are some things from between Libra 1.0 and Libra 2.0 that they have addressed, which I think has gone some distance to solving some regulatory issues. For example, transitioning from a multi-currency token to a single currency token makes monetary policy and securities law issues somewhat cleaner, I think, from their perspective. There's still the issue of being based outside the U.S. and those kinds of things, which I think will get looked at in a serious way. But I think the general view is that we appreciate their reaction to the feedback that they received early on, and it's important to have that kind of engagement if you want to launch a project of that scale.
So it sounds like maybe regulators might be more amenable to the idea at this point.
Yeah, I would say TBD. There's directional movement, which is always positive. Whether you've cleared the finish line or not, we'll have to take a look at that.
So a big picture question for you. Right now, there's a Bitcoin bull run going on. The price is up near 20,000, which it hasn't done for years. Now, I imagine that might be a kind of scary thing for someone in your position or your colleagues in the Treasury Department, because every vote for Bitcoin can kind of be considered effectively a shorting of a national currency, or the U.S. dollar, for instance. Does that bull run make you and your colleagues uneasy?
Well, first of all, I have no view at all about the right price of any given asset. I mean, markets are markets, and prices are a reflection of what a buyer and seller will transact at any given moment. So I don't have any idea if Bitcoin's expensive or cheap. I really don't. What I would say in answer to that, though, is the majority of Bitcoin holders are outside the U.S., and so I wouldn't look at Bitcoin as shorting the dollar. I think what I would look at it as, in part, is a reflection of concern about kind of the global climate overall. We've just come out of, maybe we haven't even yet come out of 9 months of pandemic lockdowns globally. There's questions about, sort of the money supply, not principally in the US, but around the world, and what that means for the stability of various fiat currencies. So I think that probably is a reflection of what's going on with Bitcoin, and it's probably good for the world that fiat currency stability be respected. And so if that means that Bitcoin was at a lower price because the background economy was stronger, that's probably a good thing. But having said that, again, markets are markets. There are a lot of people who own this stuff, and they're owning it for a reason. My main focus is making sure that the risk in those assets, the money laundering risk, the terrorism financing risks, are looked at in a serious way without killing the networks they power. Because as a banking regulator, I'm more focused on the system than I am on the asset.
So at the same time, there's a lot of this hand-wringing going on that the U.S. is falling behind other countries potentially from a central banking perspective. People are talking about the need for a digital dollar. China already has launched pilots in various cities, and the benefits are sort of clear in terms of being able to disperse stimulus payments. Especially, it's become clear with the pandemic happening right now, and talks of potential upcoming stimulus package. Should the Fed issue a dollar of its own? Where does the U.S. stand with respect to the rest of the world?
Yeah, well, look, I can only speak for myself and my own agency on this. I think there's a diversity of view. But what I tell you is I think that there's a clear binary choice between digitizing the dollar by means of a government-issued token or digitizing the dollar by means of a variety of private sector technology innovations that will offer us a lot of different features to use. My basic view is if it's a government-to-government competition, there are more people in China. China's got more of a command and control government than we do. Man, if it's government-to-government, they might win. When the U.S. usually wins is when we unleash the power of our creative innovators, right? When we unleash the power of markets. When we do that, we invent cooler stuff than anybody else does because we're freer. And so my basic view is private stablecoins are going to win if we let them win. If we decide to go government to government, my worry is we'll wind up building the Maginot Line of finance, which governments often do. It's a big, beautiful, really strong thing that's pointing in the wrong direction. And at the end of the day, that's not probably how the U.S. wins. The example I give, Robert, is if you look at your cell phone, you look at all of the different communications apps you have on it. You have WhatsApp, you have Facebook Messenger and SMS messaging, an email app, and various other things. The reason you have that is because back in the 90s, we didn't say that the FCC was going to build apps, right? We said the FCC would just establish some communication standards and we let the private sector build apps. And the result is we have many of them. So that's my view. Unleash the markets. We will win if we do that.
I really like that image that you've conjured of a Maginot Line of finance. I'm going to be keeping that in mind. If you could snap your fingers and fix one thing from a regulatory perspective immediately, no questions asked, what would it be?
I would love to be able to simply redefine what banks are. That's our biggest problem in the U.S. is other countries have figured out that they're e-money providers, non-banks that are engaged in banking activities. And we let those companies compete on par with banks. They get to connect to their central bank payment systems and everything else. We don't have that in the U.S., and it's sort of hard to understand why. You've seen lots and lots of banking activity leak out of the banking system over the last 10 years into these non-bank fintech platforms, such that they're indistinguishable from banks. You've got fintech companies that are processing payments like a bank does. You've got fintech companies that are lending money like a bank does. And yet, because they're not banks, we don't let them either A, have the safety and soundness of supervision, the way that my agency provides, or B, connect to the various central bank services that are really important. And so that's why I do worry that other countries are going to outcompete us. And that's because we've got a 19th century view of banks in the middle of the 21st century. So I would be very clear that a bank is a collection of activities. It's not a particular business plan. It's not a particular collection of people. You're lending money. If you're taking payments or if you're taking deposits, I think you're a bank.
That's a very interesting idea as well, especially as we enter this world of decentralized finance and software takes over so many of the functions that were previously, instantiated in entities like banks. It's going to be incredibly interesting how your agency and others grapple with that kind of burgeoning industry. Is that something you're paying much attention to? Is it yet a problem that you're having to cope with? Or is it small enough where it's...
I am so glad you asked me that question. So Robert, you're familiar with the self-driving car, right?
Sure am.
So Google and Uber and others are out there. They're piloting these self-driving cars, and the promise of the self-driving car is think about all the problems it'll solve. It's going to solve traffic flow problems, fuel consumption, drunk driving will go away. I mean, self-driving cars are going to be amazing, and yet self-driving cars also present all kinds of other risks out there, right? Like who's responsible in the case of an accident? You're not the one driving it. So how does a regulator think about self-driving cars? I've been thinking a lot about DeFi, and what I've concluded is DeFi basically is a self-driving bank, right? So imagine a world where there is no credit committee, there's no loan officer or bank teller. It's just open source software doing all the stuff that a bank does. It's a self-driving bank. And the beauty of it is DeFi will solve a lot of banking problems that we've regulated over time. There won't be fraud because there's no person behind it to make money. There won't be discrimination because it's open source. And if there's bias, somebody can go correct the source code and fix that bias. But it will create other problems just like self-driving cars did. So when I think about self-driving banks, it is the new frontier. It's not as small as people think. I mean, I think something like $13 or $14 billion of assets are already sitting on DeFi protocols. So we definitely need to think about it. It's not big yet, but like any other issue, it's both an opportunity and a challenge. And if we get out front of it and think about it, we can let it grow and let it be successful. But if we wait too long and it becomes dangerous, then there'll be an impetus to kill it. So I think we need to be thinking about this now. Thank you for that question. That's great timing.
That's a great analogy, self-driving banks. I definitely agree with it. It also conjures to my mind the idea of a flash crash in the banking world and crashing in the self-driving car world. And hopefully we can create technologies that prevent that stuff and proper rules and regulations to guide it all. One thing that you have been pushing in your perch is to remove politics from banking. You've got a proposal that you're trying to get pushed forward that would prevent banks from not lending to unpopular industries. Whether that's prisons, gun manufacturers, companies involved in fossil fuels. Why are you adopting this sort of rigidly apolitical approach? Why is that the right one?
Well, A, I've got a philosophy about this, but B, I've also got a whole bunch of OCC precedent on this, which I'm tasked with enforcing. So my basic philosophy is finance is the infrastructure on which we all build our lives, right? And so it shouldn't be making choices about how we build our lives. In a liberal society, we're supposed to each get to decide what our happy is, and we go build that. It's kind of like, imagine if we had a rule that you couldn't drive on the road if you were an oil company. That's crazy. The road's right there, and anybody can drive on the road, right? And yet it was built by taxpayers. What if people protest? What if they're unpopular? Okay, could you block the road to the oil company, or to the independent ATM operator, or to Planned Parenthood, or whoever else is controversial at the moment? We don't let people use infrastructure that way. Infrastructure is open to everybody, right? Not just the privileged or the favored. Finance is also infrastructure, and so you might want to start a nightclub, and I maybe am a member of a religious sect that doesn't believe in dancing. So who gets to decide if you can build that nightclub? Me, right? In America, we don't do that. And so my concern is that we have been saying at the OCC since the early Obama administration that it's not okay to boycott entire categories of lawful activity, that if you're a bank and your customer is not breaking the law, then the only ground on which you can refuse to serve that customer is because they present some particular risk. So like if I'm an oil company, but my revenue is so lumpy that I might not be able to make my loan payments, you shouldn't do business with that oil company. But if I'm an oil company who has 10 years of strong cash flows and I'm supplying the heating oil for everybody who lives in my community, who is the bank to say I want to choke that off, right? That's just sort of bizarre. Or who are banks to decide whether the savings of lives that we get by being energy independent and not being drawn into foreign wars in the Middle East is more important or less important than the potential of climate change because of oil? They're both risks. It's the job of markets and our elected representatives to decide those things, not bank CEOs at the end of it. So that's it. It's like, do you want somebody to tell you that you are too unpopular to use the highway or not? I think not.
Brian, it's been a pleasure having you here. I realize we've run a little bit over our appointed time. Thank you so much for sharing all your insights, everything from Country Coin, which is a radical idea and I hope does take off, to self-driving banks. You're clearly leaving your mark on the agency that you're in, and I wish you some good luck when it comes to your confirmation hearing.
Well, thank you so much. Pleasure to be here.
Thanks, everybody.